In this video, we're going to see how you can use LV Financials to help you determine whether putting a larger down payment on a loan would be beneficial or not. To do this analysis, you will need a premium account so that you can access the premium loan planning tools. To start off, go to the Tools drop-down in the top right and go to the Loan Planning dashboard. Click on the Loan Planning tab. From the drop-down here, you'll want to choose Principal and Interest Rate. Here is where you can enter the details of the loan. So let's suppose that you want to buy a car, and the car loan that you're taking out has a 5% rate and a term length of 60 months, or 5 years. You can enter those inputs and then click Make Plan. Then scroll down to the graph. This graph shows the possible principal and monthly payment combinations for a 5-year loan with an interest rate of 5%. The first thing you'll want to do is zoom in on the graph. So here on the y-axis you have the principal amount, which is the cost of the loan, and you can see that it goes all the way up to $500,000 and higher. But since your car, we'll suppose, is only $22,000, you want to zoom in on that amount on the graph. We'll zoom in just a little bit more. And now hover over the points on the graph until you find a principal amount that is pretty close to $22,000. Here you can see that the principal is $22,042. For that principal, with a 5% rate for a 5-year loan, your monthly payment would be roughly $416, and the total cost of the loan is roughly $2,915. The total cost of the loan is the total interest that you'll pay over the lifetime of the loan. Now, to answer the question about down payment, you want to think about how that down payment will impact the principal. So, you're starting off with a loan here of $22,000. Let's suppose that you're willing to put down $2,000 to bring that principal down to $20,000, and consider how that impacts your monthly payment and loan cost. So you can just scroll down on this graph until you find a number that's close to $20,000. For example, this point is pretty close. You can see that the monthly payment has dropped to $376, and the total cost of the loan has gone down to $2,635. So you can see that you're saving about $300 on the total cost of the loan, and you have a lower monthly payment. However, what if you have more money to put down? So you want to know, instead of $2,000, what if you put down a large chunk of cash? Let's say that you cut the loan in half and you put down $11,000. So now you're only taking out a loan for the remaining $11,000. Hover over the graph until you find a number that's pretty close, and you can get an estimate of what the monthly payment and cost of the loan for that amount would be. Here you can see that the monthly payment is now $206, and the total cost of the loan is roughly $1,443. So by hovering over this graph and estimating different down payments, you can see how that would affect your monthly payment and total cost of the loan. So by cutting your loan in half from its original $22,000, you've almost reduced your monthly payment in half. So while this would give you the information you need to make a decision about how much you should put down, you might also want to consider the opportunity cost associated with that down payment. So maybe your down payment would save you in interest that you would pay on this loan, but what is the opportunity cost of that? If you can afford the initial loan of $22,000, if we go back to that point, you can see that that initial loan would have a monthly payment of roughly $416 a month. So if you can budget $416 per month, what is the opportunity cost of that down payment and reducing this monthly payment? Well, you can figure that out by going up to the savings planning tool.